What's up, everyone? Welcome back to the Commissioner Keeper podcast. My name is Cameron Hodge, your host, and also owner and lead tax preparer at Super Dad Tax LLC. Hey, welcome back for another week. This week, I decided to kind of get a little more technical than last week, and I'm kind of talking about S corporations. Going to give you an overview of what it is, and does it make sense for you, especially those realtors out there who obviously are my primary clients, is when does it make sense? And I'll tell you this, I'll actually give you a story, but first a disclaimer. So obviously everything intended in this podcast, and if you look online for our newsletter, it's for educational purposes only, okay? Everyone's situation is different. You don't want to be going out there just creating corporations if you don't know what you're doing. Get an attorney. Same with tax preparation, hey, investing advice, things like that. This is purely for education. So make sure you take the ideas. If something stands out to you for your personal situation, obviously you can always schedule a call with our team. But more importantly, you go find your professional and you get the proper advice for your situation, okay? This is just general advice, general ideas, but I'm going to get as in-depth as I can as we get along, okay? So back to what my story is. Okay, so when I first got started in the real estate industry as an agent was in 2020. And obviously I worked for a top couple percent brokerage team in San Diego County. Naturally, I did have enough experience from a business prior and also having real estate investments is like, I need a good tax professional. I was at that point. Still fresh out of the military by 2 years. I'm like, I need a professional. Makes sense, right? Well, I went out there and they were like, oh, we use, this person. Not going to throw them out there because we're still friends, even though I don't use them now. But, they was like, hey, you need to create an S corporation. So what did I do? Went out, obviously in California, because they want to be different than every other state. Obviously, always look at your state laws. I had to create a regular corporation because I had a professional license. And I immediately, within 3 months, which is the rule, elected to become an S corporation. Well, it wasn't until 2 years later, because I, didn't make much. I think my best year during those first 2 years was I took home after expenses maybe $40,000. Okay, maybe a little bit more. Maybe it was like closer between $50,000 and $60,000 net. Those first 2 years. No one told me when he told me to elect an S Corp. Never knew I had to do payroll. Didn't know what the heck I was doing. Luckily, I had a separate business bank account. Had all fancy with my name. This is my company, blah, blah, blah. Man, thankfully, because I wasn't earning enough, I was able to work through and do things properly. But I'm telling you, especially even in California, where just by creating a corporate entity, as a small business owner, you're paying $800 a year before anything else. Like, you make no money, guess what you're doing? You're paying at least $800. And for someone just getting started in the industry, that was crazy. I did not know that I could have still just been a sole proprietor, and I probably would have been in a better position instead of, not properly managing an S corporation. But hey, that's neither here nor there. Let's dive into everything you need to know about this, okay? So, what is an S corporation? So obviously I just told you how in California I had to do a regular corporation, not an LLC, okay? I'm not going to dive into the difference. Look into your state rules and regulations, right? Like what you're able to name it, things like that, okay? This is purely, we're high level here. So an S corporation essentially is any regular corporation or LLC where you have an individual owner and it's a small business, which all of you listening to this are small business, unless for some reason, again, you're the owner of like Keller Williams, you're Keller Williams himself listening to this or something like that. You know what I mean? Like, irrelevant, okay? So all it is when you create a company, you have within 3 months to file with the IRS. And obviously, you look online for the foreign number, guys. I'm just going in depth here, okay? These are quick and effective podcasts. But essentially, you're mailing the form into the IRS and you're saying, I want to be taxed as a pass-through, okay? I want to be taxed in S corporation. I don't want to have to pay corporate tax, right? This is a self-employed corporation, but you do use it. It has purpose, okay? Again, I'm super high level. I'm not trying to go in the weeds here. But essentially, once you elect that, either within the first 3 months of company formation, or you do have the option, if you already have a company and you haven't elected S Corp status yet, I'll give you an example, okay? So I got licensed in Florida, obviously several years after being in California because we had moved there at the time. And in Florida, I'm allowed to have an LLC. Okay. Well, I knew because I was getting started in a new state, my income probably wasn't going to hit the threshold that we're going to cover later in this to make sense for an S Corp. So I just created an LLC, Cameron Hodge Realtor, LLC. And essentially, I just went out being self-employed, right? That entity looks fancy, right? It allows me to open a business bank account. I can do a business credit card, blah, blah, blah. But tax-wise, the money it's irrelevant. Like, it just passed through to me, and I tracked my expenses, took my income, and I paid self-employment tax. Florida has no state income tax, but I paid all my taxes just normally, okay, at the end of the year. Well, because I didn't do that within the first 3 months, I knew, let's see, what was that, in 2022, I knew that in 2023, because I had the systems in place, I was going to make enough. That S Corp would make sense. So, what did I do? Well, at the turn of a year, you have by March 15th to file S Corp status. So if one of you out there have a company, you haven't done it yet, you have time to file for that status at the beginning of a year. But if you miss that deadline, guess what? That whole tax year, you are not getting the benefits that we're going to cover here shortly. So I knew that because I filed in February of that year, right before I did my corporate taxes, I knew that next year when I did my taxes, I was able to utilize S Corp for the remainder of the year. Okay. Now, that obviously covers a lot of hurdles, right? It's not simply just filing a piece of paper and that's it. You have a lot of responsibilities that we're going to be covering here shortly. Okay. So that's down and dirty. S Corp. Literally just filing a piece of paper. It's all paperwork. Nothing other changes, but your responsibilities inside your company. That's the big stuff that changes. Okay. Your state rules regarding LLC and corporations, those are still in effect. What this is for what the IRS needs you to do and requires of you to do. But it opens a lot of doors, especially if you're making good money. Okay. So jumping into it, we're going to slowly work through one step at a time. All right. So why do taxes hurt so much for real estate agents? Look, we all know that, especially in like California, right, where I got started, holy crap. Not only did I have self-employment tax, right, which is an additional tax on everything. So you're paying 15.3% right off the gate, self-employment tax, okay? Now, I'm not talking about, reducing it, having expenses in your business, none of that, okay? We're talking whatever you have net going to you. All these numbers are just what's net after the business, after you paid all your expenses and everything. We're keeping it simple here, okay? But 15.3%, not even including the 12.4 in Social Security, 2.9 on Medicare, right? Like this, guys, you realize that in the corporate world, right, and most of you probably do, I hope you do, but your employer is paying a portion of your responsibility for these taxes. When we're self-employed, we're eating that, right? We're eating the full amount to pay into it, okay? Hey, look, I'm not saying don't pay your taxes, right? Death and taxes, two things that are, Benjamin Franklin, two things that you can't avoid in life, death and taxes, okay? But you're losing all of that. That's not even including your state income tax, right? Federal income tax. Like that's just an additional tax that you are having to pay, all right? Now, what does an S Corp change? Okay. It's like, all right, Cameron, great. Like, if I make $100,000, I'm losing just in self-employment tax, like over $15,300. Like, okay, awesome. What does an S Corp change? Well, it changes a lot. Okay. Now, remember, when you have that W-2 job, you're bringing that money in, just like an S Corp, you have to put yourself on payroll. Now, there are additional costs associated with that. I'll cover those at the end. But you put yourself on payroll. So now, that $100,000 that you are paying yourself, you are now taking that two different ways. Okay. So here's the magic. Okay. Quick ideas. Let's say your net income is $60,000. Okay. You pay yourself salary of $60,000. On a sole proprietor, you have about $9,100 approximately in self-employment tax. Well, if you took that in salary, that's only about $3,000. Okay. At 120, 16,000, 17,000 versus 7,700 approximately. Okay, you see what I'm getting at? Like you have the ability to protect yourself in taxes. Now, don't get me wrong. Just because the big avoidance you're having is self-employment tax. You still got Social Security. You still have income tax. You still have all these things that are getting paid in payroll. So you're not avoiding all those other ones. It's the self-employment tax that the S Corp really protects you in. Okay, so that's the real moneymaker here. So like once you make enough, it makes sense. Now, making enough. You're like, okay, Cameron, great. I get it. I get to avoid self-employment tax. At what point does an S Corp make sense for my business, right? Now, most of you, if you're seasoned capping agents and you're doing great, guess what? If you're a capping agent, probably makes sense. Can't guarantee. I'd have to sit down and look over your finances, see what's going on. But if your net income is over these amounts, you should start looking at it. So we're going to work our way up. You're earning like take home less than $40,000 a year, right? After expenses, everything. Like your taking home is $40,000 or less. It probably doesn't make sense because there are costs associated with payroll. And I don't really recommend you do payroll yourself, right? Now we do payroll for agents, but you can easily go out there, and if you want to get down and dirty, like hey, agents are jack of all trades, you can go use the Gusto or QuickBooks has payroll, right? Like there are services out there that will help you with payroll to calculate your taxes and do everything for you, okay? Right? Because you have to submit those on a quarterly basis. You don't need to be doing that yourself. So I recommend 1,000% tools to cover payroll. Not the point of the rest of this video. You start earning $50,000 to $80,000. That's really where, if that's your net take home between $50,000 and $80,000, that's really where you need to be sitting down with a professional or doing some serious research to see if it makes sense for you. That's really the threshold. That's the minimum threshold. Once you are net taking home that area, that's really when you need to start looking at this status, because let's be honest, you don't need to pay more money to Uncle Sam than Uncle Sam needs. Now, if you're making over $100,000 a year plus, if you are the only one in your business and you're not like a partnership, remember, this is just you by yourself as the owner. I promise you need to be doing an S Corp. Like it's pretty obvious. If your net take home is more than $100,000 and you're consistent, then you really need to be looking at this, because you're losing thousands and thousands in self-employment tax, and no one needs that. Okay. Remember, the goal is if you're able to save more in taxes than you spend paying yourself payroll, it's time, or at least it's a good rule of thumb. Doesn't mean it is. You need to sit down with a professional, but it's usually a good rule of thumb. Hey, it's probably time to start looking at this, okay? Now, here's the big catch, okay? You're like, Cameron, great, S Corp, save money, I'm making this much, time to do it. Now, you're going to hear this reasonable, you might have already looked this up if you have yourself. There is a general guideline where you have to take a reasonable salary, okay? And the reasonable salary rule, okay? There is no exact qualifications for what is a reasonable salary. The IRS just says you have to take a reasonable salary. Now, what could that mean as a real estate agent? Could be what the agents in your market are earning in your similar role, okay? Like, what is the average agent making per year in your market? That's a good place to start. Your duties, how many hours you work, what are you doing, how long are you working, okay? And then industry norms. Like, there's always a national average that you can find online, especially with the Labor Bureau of Statistics. Sometimes, depending on your area, you may be able to find good data, and that's where you start. You're like, hey, Cameron, that's where my salary starts. If you want a general rule of thumb, I've heard this a lot. Again, it really depends on anyone's situation. You can use the 40-60 rule, okay? Which means 40 to 60% of your net income, right? Whatever's left in the business that you're able to take and pay yourself, 40 to 60% is your salary. Now, okay, it's not official law. It's just a safe guideline, okay? Again, I've seen people be able to push a lower salary and take more when I'm about to talk next, okay? But remember, you don't want to get an audit. Like, you don't want to cause yourself to get an audit by taking like $5,000 a salary and then you got like what I'm talking about next, which is distributions, okay? But that's where the cool part is. So, remember how we talked about you're putting yourself on salary? So your company's paying a portion of your Social Security, your Medicare, your income tax. You're paying a portion of those three when you pay salary. What happens, right? Let's say you take 60% in salary. What happens to that remaining 40% that you were going to take yourself? Well, you take it as a distribution, right? Like, because when you create an LLC by itself, or a corporation, but let's say an LLC, because corporations, really, it's only California that I know of. Again, check your state. I'm pretty sure that's the only state that freaking requires a corporation instead of an LLC, like a C Corp. But, so I'm going to do the general, which is going to be an LLC, right? It's just a pass-through, right? It's there for legal stuff, so you can look fancy with a name and all that, but essentially, you're just paying yourself. When you create an S Corp, you're going to have like a board of directors, right? So you're going to have to put yourself on a board, quote unquote. You're going to have annual board meetings, all that stuff, okay? Even if it's by yourself, all right? Like I said, it's not for the faint of heart. There are rules that go into this. Now, That remaining 40% that you didn't take, right? You're a shareholder. You can have a distribution that is not subject to self-employment tax. How cool is that? Right? Like you're like, I get to avoid having to do payroll and I can just take that money and give it to myself as a distribution. You betcha. But that is why the reasonable salary rule exists. You have to be sure you're not like, you know what I mean? Like you shouldn't be taking all that in a distribution like I was, like an idiot. You need to have a reasonable salary for your area as an agent or broker. Other than that, hey, once you figure that out, the rest of it can be in distribution, so you don't have to pay that tax on it. Okay, let me give you an example to sum it all up. You make your net take home is $100,000. You have $60,000 in salary, okay? W-2 payroll, paying yourself every month, quarter, whatever. The remaining $40,000 as a distribution, that's reasonable. Okay, like that's avoiding self-employment tax. Like how cool is that? Now it will be what's called a K-1 at the end of the year. Like you will disclose you took those distributions, and it affects your bottom line. But that is the rough cost. Also, keep in mind, when you pay yourself salary, guess what? The portion the business pays for your salary and your salary, that can cut towards taxes and expenses. Like that brings the bottom line down. Okay, not going into that too depth because all of you have way different ways. Like you have my virtual assistants, all these different tools and software and lead generation. There's a lot of different ways that this gets broken down. Because just because you might be able to save taxes one way doesn't mean we want to take that way. You might want to take a different strategy depending on what lead source, what path in your business you're taking. Some of you might just be straight, brokers, and all you do is property management. Again, there's so many different subsets in our industry. So you gotta, like I said, this is all just general rule of thumb. But here's where it really got me excited that I wasn't doing when I had my S Corp originally. I totally forgot, just because I was young and dumb. I was only mid-20s when I started. I forgot that because when you create an S corporation and you're paying yourself salary, now you don't need, one of these examples, you don't need to have an S Corp to have this make sense. I could have done this already. I'm just ridiculous, I guess. But when you pay yourself salary, right, you're paying your portion of taxes, your company's paying a portion, you've created a separation where now you can really start to do some retirement accounts, right? The one thing that I think drives me crazy in this industry of real estate agents is there's so many that don't plan for retirement. Now, most of the top producers, and some of you may already know this, but man, a lot of us get started younger in the industry and it takes too long to actually build a solid plan of like, hey man, like, you don't have, like, there's, like, unless you're buying rental properties, which I do like rental properties, but, like, there's no other way where you're going to get retirement savings. You're going to rely on Social Security. I'm sorry. No offense. Even though we pay into it, I am a firm believer that I really don't think I'm going to get Social Security when I turn 67. I don't think it's going to happen. I really don't. So that's how I run my life, is I realize that me and my wife have to plan to have our own retirement. Now, what can you do, right? How does this look? Now, again, I'm not a financial, like, you find your own path, find your financial advisor. I am simply just giving some ideas out there, okay? But you have Roth IRAs, right? Like you can put the limits, as long as you're making, under the yearly limit. At this time, starting at around $161,000 for single filers. If you're filing jointly, it's $240,000 per year income, right? That's when, the Roth IRA kind of closes out to you. Now, there are some backdoor IRA methods, Roth IRA methods, to where you can still give money into it, but this is not the point of this podcast. Again, I'm just getting into it, the basics, like how cool it is that you have an S Corp. Well, it's like you can put in $7,000 per year as long as you're under that income limit. Now, remember, like for example, my wife, she works hard, but she doesn't actually have at this time a regular W-2 income, right? I am still able to open up a Roth IRA for her, and now I can also do $7,000 a year into her. Now, the Roth IRA is not special in terms of taxes. You're taking income tax, you're paying yourself payroll, and then you're putting that money into the Roth IRA, but it grows tax-free, which for a lot of you, I don't know about you, as I grew in this industry, and I'm still buying, helping people buy and sell real estate, investing, every year I want to get better than my previous year, which means our tax base goes up, which means the sooner you start putting into it at that $7,000 per year, the better off you're going to be. Now, if you're over 50, it's currently this year, it's $8,000 per year. But hey, that's just a small way that you can set aside your money. Just wanted to throw that out there, okay? There's also, don't forget, for Roth and solo 401ks, you can also, now again, there are rules to this. You need to find an intermediary. Like, it's not just simple. You just go online and set it up, okay? You got to find a professional. Again, taxes, bookkeeping, I got you. I'm not giving you financial advice outside of tax implications. But the cool thing is like you can buy real estate in a Roth IRA, and you can buy real estate in what I'm about to talk about, which is the solo 401k. Okay, now there's different types of 401ks. Again, I'm just rough examples. But here's a really cool strategy that I wish I set up. Like when I broke and my take home was $106,000, I didn't have my S Corp set up properly. I lost all that money because I screwed up, didn't take a reasonable salary, and the IRS is like, well, it sucks to be you, Jack. You're now paying all your tax because it's your fault, right? And you have to be careful because if that happens, you have an S Corp right now and you're not doing salary, you're not doing everything you're supposed to, the IRS can take away your status. Okay, so you have to be careful. Now, a 401k, right? Remember, you're paying yourself salary. So here's what really excites me when you get to do S Corps and you really start making good money in this business. Okay, now, as a W-2 employee, you can put up in 2025 $23,500, right? Now, it's based on your income, okay? So we're just going off of $100,000, okay? You can put up to $23,500. Remember, that's tax-free. Right? You're setting that money aside before you pay your salary. So when you're doing your payroll, your company's paying you, that money is getting separated before income tax is calculated, right? No, we all know when it comes time to retire, you pay income tax at your bracket for that 401k. But hey, for right now, if you're making good money, why would you want to give the IRS more money now than you need to, right? Like you want it to grow. And if you got the extra money to set aside, why not, right? You can still buy real estate inside of these retirement accounts if you set it up properly and it's the right entity, right? Now, I like to own active rentals, but it's pretty cool that you could occasionally buy some rentals under those entities. Hey, food for thought. Take it, run with it, look it up. Now, don't forget, even though your portion is capped to that amount, your employer, your business, can contribute 2025 up to 25% of your yearly salary or of your salary into your 401k as a match. Yeah, you hear that? Like how cool is that? Like your company is also creating a match, right? You're literally creating your own wealth business, but you're in control. You're not working for a company. You don't have to worry about your company laying you off. You're the one running the show. You know how your business is doing. You get to take that money and grow your life, your family. And I wish I knew this when I was actually doing it. So let me give you an example, okay, of the solo 401k. Let's say you make a salary of $100,000, okay? On the employee side, you got $23,500 pre-tax, boom, goes into 401k, all right? On the employer side, they contribute $25,000 with you. That's $48,500 in 2025. Tax-free, you are throwing into a retirement account. Yes, when you go to retire, you will pay taxes on that. But for this current tax year, you get to save that amount, right? Like that doesn't count towards your income because you let it go before you had to pay income tax. Freaking rock solid, right? Like, especially if you're using both of those in combination, you can really do some damage. I mean, that's $55,500 in these examples that you just threw into retirement accounts, right? Now, I get it. The world's expensive. $100,000 doesn't go as far as it used to. I'm not saying that's your ability for everyone to do, but that's okay. That is how awesome it is. You build your situation, but how cool is it that you could set this up? Maybe you're not contributing fully right away, but why would you want to give more up in taxes? Like this is only like a piece. If you think of like 1,000, 10,000 piece puzzle that you're building, this is only a small piece. It's so much more complicated, but this is just a small idea I wanted to leave you that S Corps can do too. Okay. Now, outside of retirement savings being on salary, don't forget, you also have the 199-A deduction, okay? This is a qualified business income deduction under current law that allows many small business owners, which I assume all of you that listen to my podcast are, deduct up to 20% of their qualified business income. Now, again, this is not tax advice, legal advice. You're not sitting down with me. We're not going through your books. I'm not looking at your previous tax year, how this year is going for you. But again, this is a deduction, current year, that allows you, so your distributions, again, the part not subject to payroll taxes, maybe, potentially could qualify for this deduction, okay? So you're now balancing salary and distributions and maximizing tax savings on your self-employment tax and using this deduction, right? So now, caveat, or a note. If you're a high income earner, once your taxable income goes beyond the IRS threshold, which right now is around $383,000 and change. Married, if you're filing jointly married, the deduction phases out, right? So there is an income level. If you're like Ryan Serhant, there's a level to where this doesn't make sense, and you have to go through a completely different strategy. For most of us, right, the vast majority, me included as an agent, okay, most of these are going to apply in some way, shape, or form. Does that mean that's what, say you were one of my clients, that I would sit down and I would recommend that's what we're going to do? No, it doesn't mean that's what we're going to do. But there's a good chance if you are you're starting to make good money, especially over that $100,000 mark, a lot of these strategies start playing into you, right? And in short term, it might not mean anything, right? But think about it, over 10, 20 years, by the time you actually, like for me, like by the time I'm in my 40s, my 3 boys are going to be out of the house. And with the plan I have in place over the next 10 years between buying active real estate and throwing money into these retirement plans, like there is a really good family trust company that I'm creating for my boys. Now, they screw up, I'm taking it all away, and that's in the bylaws. But I am building what I want to be family wealth. Even if it's as simple, like look how crazy the world is as agents, like how expensive the homes are. Being able to actually use this election inside your company to actually make real impact in your family, to actually have really good wealth that you can build for your family. That's why I started. I don't know about you, but that's why I started. And that's what, once I really learned how to use this entity in election properly, I realized how much of an idiot I was, that when I broke 6 figures, how much money I wasted in taxes that should have gone to my family, or at least something I was building for wealth for future taxation, not current taxation. All right. Now, I'm going to wrap this up. Just because an S Corp sounds fancy, you're like, Cameron, I want to do this today. Don't forget the responsibilities, right? You're running payroll, which means paychecks, withholdings. You have to file quarterly IRS payroll forms, 941 and W-2s at year end. Now, I do not do this yourself. Look, even being in the tax and bookkeeping world, I am telling you, I use services, even for the agents that we have, like we use tools that are out there to help us, right? Now, even the tools aren't that accurate. Like it is, running payroll is crazy. Like if you've ever had pay issues inside of a company you worked for, and you're like, how are they screwing this up? I didn't take enough taxes. They took too much taxes. It's because that's welcome to the IRS. Welcome to the modern day United States. Like it is such a complicated thing. So you want to use a tool. Gusto's one. QuickBooks has a payroll service as well. Like I love them for bookkeeping. So that's really a go-to as well. But you want to use a tool. And even then, you still need to make sure you're managing it properly. So if you're going to do it yourself, do your research, make sure you're doing it right. Obviously, outside of payroll, which is usually the biggest kicker, right? Because there are costs that you're paying every single time you do this, every single month, quarter, whatever. Outside of that, you also are filing an extra tax form for that company, right? It's a typical company tax form, but it's for the S Corp. And then you're also issuing K-1s to yourself, like your distributions, things like that. You're at doing an additional form. So there's a little bit more complication in taxes. But to be honest with you, if you already had an entity already, you're already most of the way there. So that's not, especially if you're using someone to do your taxes for you, it's not really the end of the world. If you're keeping your books properly, not the end of the world. But you are, again, if you're not used to having a business entity, a company, you're filing annual reports with your state. Okay? Got to make sure you have a separate business, the bank account, right? You have to have a book of business, right? So all the forms related to your business, you have to have annual board meetings, right? Or if you're changing like your name or doing anything serious, you should be holding a board meeting. Even if it's when you're with yourself, you need to be holding that board meeting, okay? You need to be tracking all that paperwork, because if for some reason you ever got sued, or, just like, even if you're with a big company, you're like, Cameron, they have E&O insurance. Yeah. But guess what? When they ask you who to pay on the W-9, right, at the end of the year, or not the W-9, I'm sorry, but when they're giving you the money at the end of the year, your tax forms, or when they go to pay you your commission, who do they ask? Who are we paying? Most of you, if you have a company, you're putting your company's name. So you need to run your company properly. You need to have a binder with all your formation documents, all the records of your annual board meetings, right? If you got to change the name of the company, you should hold a board meeting. If you're adjusting your payroll, even though you're the only one in your company, you should hold a board meeting. Keep the notes, keep it in that binder, keep it electronically and physically, right? Because if the day that you get audited, right, it's not a matter of if, assume it's a matter of when. No matter how good of a tax professional you use, no matter how smart you think you are, the IRS, hey, sometimes it's the luck of the draw and you get audited. So the more your paperwork is in order, the better off you're going to be. All right? Now, bottom line, S Corps can save you massive money if you're meeting those thresholds that we talked about. They unlock bigger retirement contributions than you have not having them elected. Potentially, it could help you maximize that business deduction we talked about. Not always, but it's a potential, which could be massive savings depending on your situation. But they do require discipline and compliance, right? And keep in mind, once you start doing your self-payroll, you can reduce it and increase it. But if your business takes a major hit, like I know many of us did when we had those interest rates go up a couple years ago, you have to adjust for that, right? Like, hey, you have that general 40-60 rule, but you have to realize that, hey, if my business isn't making enough, or I had a good year making $80,000 this year, but I'm about to have a child. Whether you're the woman giving birth, you deserve time off, right? I know my wife did with all three of ours. Or you're the father and you want to spend more time with your kids for a couple months, and you're going to be closing less deals or taking referral fees instead of getting full commission. You have to prepare for that, because if you're not consistently making that net threshold we talked about, this might not make sense. Even if you have to pay higher taxes temporarily, that added payroll and complexity adds up. You have to make sure you are ready for it, because it's more complication. But when you use it right, it is one of the best things you could possibly do. And as always, guys, it's a pleasure. I have a newsletter online. You can sign up, thecommissionkeeper.com. Coming soon. Should be set up this week. If you're listening to us on Tuesday, a little bit early, it may not be set up yet. You can find me on Substack, but soon it will be thecommissionkeeper.com. You can sign up to get this as well in a weekly newsletter. Also, if this sounds like something you want to do, you need guidance, you want to find out, Cameron, what is my tax situation going to be like this year? How do I plan moving forward for next year? Hey, what you do, head to Super Dad Tax. That's superdadtax.com. Go ahead, check us out, check me out, schedule a meeting in the show notes. Obviously, there's always a link to get on my calendar. If not, guys, this information is always free. Like, I really do try and give it away. The main goal is to make it quick, effective, and to generate your ideas. That way you can have a better business and keep more of your commission. All right, y'all. See you next week.